Welcome to the last section of Chapter 8. Here we're going to talk about dealing with our intangible assets and natural resources. Good news, there's not going to be a bunch of new formulas to memorize. It's going to be done relatively the same way that we've already learned for our other tangible assets. So intangible assets have no physical substance. They have value because of the rights and privileges that they confer by law, and they're usually evidenced by some type of legal document. Most common types are listed here. Goodwill is the only one that I think needs a little more discussion. With goodwill, basically the time when goodwill is created is when you purchase another business. So let's say, for example, I have a bar downtown and I'm tired of dealing with the Thursday night crowds and all of the students, so I decide I want to sell it. And the assets that I have are worth $1 million. Would I sell my business for the value of those assets? And the answer is no. I'd want to get more because of all of the things I've built over the years, the brand name and reputation that I've grown. So I'd want to sell my business for more than the underlying value of their assets. So that's really what goodwill is. Goodwill is the difference between the purchase price and the fair market value of the assets. I'm going to write it on the next line. The fair market value of the assets minus the fair market value of the liabilities. So goodwill only happens when one company buys another company and they pay more than the underlying value of the assets minus the liabilities. So if I have $1.2 million in assets and I owe $200,000 to the bank, I effectively have a net of $1 million worth of assets. So if the company pays more than $1 million for the purchase, they end up with goodwill. It's the extra amount that's paid for brand recognition and the customer base. Intangible assets are recorded at historical cost if they've been purchased. Any internally developed intangibles are not going to be recorded. So we only record the intangibles effectively when we purchase them, not when we develop them internally. There are two types of intangible assets, those with a definite life and those with an indefinite life. The only one that you need to know that has an indefinite life is goodwill. Because that brand and reputation, we don't know how long it's going to last. I'm sure you've been to restaurants that were purchased by somebody and they drove it right into the ground. It just wasn't as good as the original owners. And then you may have went to businesses where it's actually better than the original owner. So we have no idea really how long that goodwill is going to last. So because of that, we don't amortize it. We test it for impairment, and we've already went over how to record impairments. So that only applies to goodwill. All other intangibles that we talk about in this class do have a definite life. They're amortized, which, by the way, is just depreciation for intangibles. It's the same thing. It's depreciation, but for intangible assets. And good news, we use the straight line method. And most companies don't estimate a residual value for their intangibles. They assume there'll be zero value when they're used up. Amortization, again, is just a cost allocation process that's similar to depreciation, which we use for our tangible man-made or woman-made assets, and depletion, which is used for our natural resources. So once again, goodwill, you can read through what it is. I've already explained. It's the additional amount that one company pays above the fair market value of the underlying assets. And that one is not amortized but reviewed annually for impairment. Trademarks, you can read into what those are all about. Those are the image, slogans, logos that you see. The Nike swoosh would be an example. Copyrights protects the use of musical or literary or artistic work. An example you might see where copyrights get violated is on YouTube. A lot of times different people post things that have copyrights on YouTube and then they get taken down. And that, if you've ever went onto YouTube and clicked on a link and then saw like the scrambled black and white look, that's because the copyright law was violated and the video was removed by YouTube. Technology could include like website development, software, etc. Patents are usually granted by the federal government for new inventions or new processes. You see patents talked about a lot on Shark Tank. You don't need to know their legal life being 20 years, but you should know that they are a type of intangible and they would be amortized over the useful life. Franchises, that's like Five Guys, McDonald's, Taco Bell, etc., Dunkin' Donuts, Starbucks. So these are rights that you're given to open up your own Starbucks. You didn't create Starbucks, but you could still be an owner of Starbucks and open up a franchise. Licenses and operating rights. These are permissions to use certain products or services. So I might have some licensing right to use like Mickey Mouse on my product from Disney so I can sell more of my product because everybody loves Mickey. Bottom line is, with all those intangibles, what you need to remember is, with the exception of goodwill, they're all going to be amortized over their useful life using straight line. Goodwill is tested annually for impairment. Research and development costs, which can be significant, under US GAAP are just recorded as expenses. The reason for that is we don't know what the true value of those R&D costs are, and a lot of them result in no benefit whatsoever. For instance, Apple could spend a lot of different costs coming up with a new version of the iPhone, and then they go in a different direction, and all those previous costs are lost. Then when they do come up with some great idea, there's really no way to determine how much it's truly worth. So the Financial Accounting Standards Board determined that the best approach for research and development costs is to expense them as they're incurred rather than record them as assets. It's basically the conservatism principle in action again. Natural resources are tangible, but they come from Mother Nature. Gold, iron, oil wells, timber tracts are all natural resources. Natural resources, instead of being depreciated, are depleted. It's the same thing. Depletion is depreciation for natural resources. We use the units of production method. Technically, when we go cut down wood from a timber tract, that wood becomes an asset and then won't be expensed until it's sold. We're not going to make it that complicated. The book might go into that. We're just going to deplete it using units of production and record depletion expense at the time we cut down the trees. We're not going to record it first as inventory and then record an expense when it's sold. We're going to keep it simple and just treat natural resources like any other tangible asset. We'll depreciate them over time using the units of production method, which should make sense because the more wood we cut down, the more oil we take out of the well, the less value that's remaining. So units of production definitely fits for natural resources. And when we calculate depreciation using units of production, when it's for a natural resource, we call it depletion. Other than that, you don't need to worry for this course's purposes on the recording of the depleted natural resource as an asset first. Might show up in the SMART book, but it won't show up on a quiz or exam. Lastly, we're going to talk about how the cash flows related to these long-term assets show up on cash flows. Hopefully you already know the answer from chapter 1. It's all going to show up in the investing section when we buy and sell these long-term assets. That's in investing. The income statement related stuff, depreciation, gains, and losses, are going to end up affecting the operating section. We'll get into that more in chapter 12 when we cover the statement of cash flows. But for now, all I want you to focus on is the purchase or sale of long-term assets, which are covered in this chapter, would be recorded as investing activities on the statement of cash flows. And that's it for the chapter. As always, make sure you do a lot of practice, use the additional resources on Canvas and Connect, and reach out on the discussion board should you have any questions.